Futures trading involves substantial risk of loss and may not be suitable for all investors. Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago, where it is cold and a little snowy, but man, those markets were red hot to start this week's trade, not just in the agricultural space, but a lot of the other markets as well. Stock indices, precious metals, even energies finding their footing. So a lot of green on the screen to start the week, and this after the government shutdown approaches an end, and a lot of optimism coming back into the marketplace on the back of that. Now, to get things started, we'll jump over to the grain markets. As I'd mentioned, green across the screen. Soybeans the leader to the upside there with the January contract 13 cents higher today, settling at 11.30. December corn futures up 2.5 to 429 3/4, and December Chicago wheat 8 cents higher, settling at 435 3/4. Looking at the charts here in the grain markets, we had that pullback and softening the back half of last week's trade, but we tested and held the 20-day moving average almost to a T this morning. That was about 426.5, and what we've really started to see is this corn market establish basically a 10 to 12 cent trading range. The lower end of that was tested today. Then you've got the 50-day below that at 423. So 423 to 426.5, that's going to be the lower end of support, and I think a good risk-reward setup to the buy side. If that can hold, where does that take us to the upside? Well, the recent top end of the range has been near 436. 437. So that's the range that we're looking at playing here for this week's trade. A breakout below or above that, potentially that spurs the market in that corresponding direction to start a new trend. Soybeans, on the other hand, a little bit wider of a trading range, but still really friendly environment here. We've got the soybean contract basically in a range 11.05 to 11.35. We're back towards the upper end of that, which is certainly encouraging. What I would find the most encouraging about this market, though, is the fact that we had this very nice healthy rally and breakout, and we've been able to defend that strength. Obviously, we saw some weakness last Thursday, but all in all, the market is held together, and it wasn't just a flash in the pan. So there is some underlying strength and real buying showing up in this market, which is very constructive. If you look at the daily, you can make the argument that we ran too far too fast, and now we're just consolidating and catching our breath. But as I had mentioned last week, if you zoom out and look at the weekly chart of January soybeans, it really just highlights the fact that this market hasn't done anything all year long, and the breakout above 1085 to 11 potentially opens the door for a bigger move going forward. A lot of attention obviously going to come on the back of South American weather. Currently, they're sitting at about 72% planted for the corn crop, which is right in line with last year's pace. Soybeans, about 61% planted. That is slightly behind last year's pace due to some irregular rainfall. So that's going to be watched very closely. We did have export inspections this morning, pretty much in line with expectations across the board for corn and soybeans, as well as wheat. China was not in that report, but I don't think a lot of people were expecting them to be. I think in the coming weeks, that's when that would show up. So that'll be something to keep an eye on going forward. And then, obviously, we've got a WASDE report on Friday. So a lot of moving pieces. There seems to be some hatred behind the rally in the grain markets, which I like. It means we've got a market. We've got buyers and we've got sellers, and that's what gives us opportunities. So a lot to look forward to in the grain markets, especially relative to how we traded through much of the summer. Hopping over to the wheat market, wheat did gain some ground back, basically just erasing all of Friday's losses, but that just gets us back to this kind of pivot pocket near 535. We've got to see consecutive closes out above there to get some more hope of keeping this rally alive. A failure there, and I think we can see this market trickle out and trade sideways. All in all, I've been optimistic on the grain markets for a while. I remain optimistic, but we really need to see wheat get going if we want to have a chance at getting back towards that trendline resistance and marking a higher high on the back of hopefully what is a higher low from Friday's session. Now, jumping over to the cattle complex, big moves higher today. Locked limit higher across the board, so we will have expanded limits in Tuesday's trade. I'm sure we'll get a little bit of follow through tomorrow, I would imagine. Whether or not the bottom is in is the gazillion-dollar question. I still think that these are probably largely relief rallies. If we can get towards 234, 235 in that December contract, I wouldn't be surprised to see that act as a resistance point. You've got some major moving averages there, as well as the upper end of this consolidation range between the end of October and start of November. So Again, I think if we get some follow through on this, hedgers maybe want to take a look at being a little bit more proactive against that resistance pocket. And then for feeder cattle, similar type of setup. I think you get back towards this consolidation range, maybe into this gap. But from there, I think you're going to want to be a little bit more proactive in protecting the downside. Again, that's still well above the market. These average daily trading ranges are very, very wide, so be sure to manage your risk accordingly. And last but not least, the big sleeper of the day, the lean hog market finally woke up, got out above the 200-day moving average with some conviction, clearly. Big move higher, up about 3.5%. And one of the things that we've been talking about in the lean hog markets is just it's been very, very quiet, almost like the wheat market from a couple weeks ago where you saw the volatility reach multi-year lows and it just continued to bleed lower. And then boom, just like that, you get a snapback like we saw today. Today's session erased about 3 weeks of losses. So we had the trickle lower, but all it takes is one day. And obviously you can see what transpired there. I think we can see some follow through here. But I don't know that I'd be holding my breath for much more than a couple bucks from these levels. So you're looking at about 85, which was a congestion area through much of the summer months and into the fall. So that's what we're looking at for the grain markets and livestock markets. A couple other markets on the move, gold, silver, oil. If you have any questions about any of that, don't hesitate to reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.